My name is John Duffy. I'm the Vice Chairman of KBW, the parent company for Keefe, Bruyette and Woods, a broker-dealer that specializes in the financial services sector. And this morning I'm at the NASDAQ market site at the Bank Director Conference, their forum on lending. Bank profitability at the end of the third quarter, our research department actually raised more estimates for 2012's earnings than we lowered. So I think that would say we're somewhat optimistic about improving earnings performance for the industry. I think the one caveat is a lot of the earnings gains that we're forecasting in 2012 versus what we think the banks will report this year is being driven by lower provision for loan losses. And obviously there is some limit to the sustainability of that particular line item in the P&L. So we are optimistic. Things seem to be getting better, but there's certainly challenges still remaining for the industry. This year, 2011, certainly been a challenging year for the banking industry. Despite improving profitability, we've seen stock prices decline for both our regional banks and the large cap or money center type banks. We believe a lot of that poor price performance is driven by the overall equity markets, where the flow of funds coming out of the large mutual funds has been decidedly negative. And I think as the economic recovery has been somewhat uncertain, bank investors generally have decided to lighten their weighting in the financial sector in terms of the amount of banks that they want to own in their portfolio, and they are somewhat concerned about loan growth and margin issues. So I think there are plenty of challenges out there, and I think that's weighed on the stock price performance, especially because of the money coming out of the equity markets in general. Well, certainly I think bank valuations would improve if the overall equity markets would improve. I think there's uncertainty in the bank sector. Two issues. One, when we're going to get back to a more normalized level of earnings for the industry and banks specifically, and also what that new level of profitability is going to look like, because I think generally people do not expect banks to get back to the levels in terms of return on equity or return on assets that we might have seen in the middle of the past decade. So certainly consistent performance, and I think banks that have an ability to generate earning assets in this challenging economic environment will be rewarded by investors. So I think it's a consistency issue. I think it's also a growth issue, because growth is tough to come by for the industry right now. M&A activity has certainly been very quiet for going on 4 years now for the banking sector, at least relative to the numbers that we had gotten used to seeing in the decade of the 90s and the past decade. Again, I think better valuations in the equity market would go a long way to jump-starting the consolidation wave that we expect to see. A little bit more certainty in terms of asset pricing would be helpful, and in that I mean the commercial real estate market, which had been recovering really from 2009 until the spring of this year, but that improvement has slowed down quite dramatically in some of the regions about the country. So I think the buyer universe is somewhat cautious or maybe prudent in terms of wanting to take on more commercial real estate exposure, which is really what resides in a lot of the banks that probably would like to sell. So I think a lot of the sellers are waiting for better prices. I think the buyers are being cautious because of asset quality issues, and they're not delighted with where their stocks are trading. They're not eager to issue more stock at these levels to do deals. So I think the two primary issues are the level at where bank stocks are trading and what buyers can afford to offer sellers. Sellers' expectations in some areas may still also be too high, even though they've ratcheted down, I think, significantly versus where we might have been in 2006 or 2007. In some cases, I think sellers still have unrealistic expectations.